Good afternoon, everyone. My name is Greg Strachan, private broker at Emperor Asset Management, and today I have with me a very special guest, Mr. Tom Lange. Thank you very much for joining me today, Tom.
Good to be here, Greg.
In the times we're going through in the market, it's important to get a context as to what's going on. So I thought today in the interview with Tom, I want to cover a few aspects which I feel are really pertinent to my clients and clients across the global markets as a whole, to be honest. So thank you, Tom, for your time, and there are a few key questions that I want to ask. The first thing relates to risk. It's something I take very, very seriously, especially when I'm talking to clients about their portfolios. And I know it's something that's very close to your heart, and you've done heaps of information as well as investigation into risk. Help our clients understand what is risk, what is your view on risk, and why is it so important for clients to understand the differing types of risk and how that can potentially, or how that will help them understand the benefits within their Emperor investments.
Okay, Greg. Basically, there are two types of risk. The one is called volatility risk, and the other one outcome risk. Now, let's just get a grasp of volatility risk. That is what investors are currently feeling. Since April, when the market made a new high, markets come down, and as the market comes down, investors see that their investment is declining in value, and they're getting concerned. That's a very natural concern, but it is an emotional response. You are getting fearful because you are losing money. Nobody likes to lose money, and therefore it creates anxiety. So there's a lot of emotional aspects combined to what we call volatility risk. And it's important to understand that volatility risk is usually associated with what we call short-term experiences in the market. Yeah. I mean, going back to the 2008 crisis, that was a huge, fearful experience for everybody. But within 2 years, we recovered all of the losses we had and added a lot more profits on top of that. So you can also say that volatility risk is some kind of myopia illness that we can attribute to investors. And because it's an emotional response, they tend to shy away from that. And that's why we say that investors generally are risk averse. So the only way to shy away from that, the only other alternative is to put your money in a safe place, like the bank. And then you have the benefit that you are sleeping well at night. There's no emotional anxiety that an investor can experience unless the bank goes bankrupt. And that doesn't happen because the Reserve Bank guarantees investors' deposits worldwide over. So that problem has been sorted out a long time ago. So the problem with the risk that you run when you put your money in the bank is simply this, is that the returns you get after taking account inflation and tax are not good enough to meet your targets. So if you were, for instance, to take your complete pension and put it into the bank, then your pension will decline by 3% per annum in real terms. And that's not a risk that investors can see. They experience it over a long term because suddenly they realize that things are getting more and more expensive, and their $100 interest that they can receive are no longer buying the things they used to buy.
But it meets the emotional requirement in the short term. Yeah.
But there's no immediate fear because there's no immediate feedback that they are losing money. It's just that somehow the money eventually evaporates. But it's a slow process, and therefore it's not in your face, and therefore it's not experienced as fearful as what volatility risk is concerned. But if you look at it over a long period, 20, 30 or 40 year period, which is what the time horizon we have is when we want to do financial planning for our retirement, then that degrading of your investment performance, which takes place all the time and continuously, will eventually provide a zero probability for your final outcome. So you need to balance the one risk with the other one. If you take too much gearing on your portfolios or too much risk on there, then you could be facing far too much challenge with short-term volatility risk that your emotions can handle, and therefore you will sell at the wrong time.
Okay.
On the other hand, if you take only outcome risk, then you guaranteed you're going to lose all your money. So whichever way is, there's no way you can get no risk. You've got to take risk, but it's also a question of what type of risk are you taking. And that's important to balance that, and for that is knowledge necessary.
Okay. So just to sum that up, there's essentially two types of risk. There's the emotional attachment one has with their investment,
Yeah.
From a comfort point of view,
Yeah.
and wanting to make sure that they feel comfortable in the short term. And the other risk is not taking enough risk, essentially,
Exactly.
to give you the outcome that you want.
Exactly.
And playing too much in the former results in a midlife crisis between 40 and 50 when you realize that you don't have enough money.
Yeah.
Because you've taken a far too conservative approach, which has provided you with comfort, but would put you in a...
So the easy example here is that if you put your money in the bank, or let's say even slightly better, where you get 1 or 2% above inflation,
Mm-hmm.
you sleep at night, there's no volatility, there's no fears that you have, and you think you've made the right mistake, made the right choice. So over a 30, 40-year period, you realize that by the end of that period, you needed inflation plus 5 or inflation plus 7%, and now you only got inflation plus 1. So the outcome finally was that you got far less than what you anticipated, and therefore you did not meet your financial requirements for retirement.
Exactly. And I think it's so important to actually talk about that, because especially in the market moves and with the transparency that Emperor has for clients, is that over the last month when we've seen some big moves on the downside, which obviously people are more sensitive to, is that knee-jerk reaction to want to take their money out and go to cash and protect their investment. I think that's what that's really talking to, is to avoid doing that, especially when you've got 3 to 5 or even longer term outlook on your investments.
Okay, let me just add to that. In my latest market review, there was a additional piece that I wrote on that type of knee-jerk response.
Mm-hmm.
And it turns out that the only time when you can actually beat the market by getting out and then getting in is when after you've taken a loss of more than 25% already. And only then getting out and then jumping in as soon as the market has gone up 8%. That's the optimum point. Any other combinations of when to wait and when to get out and when to jump in again gives you less optimum returns than what you would have had by just keeping your money where it is. Okay.
Fantastic.
So whatever you do, the bottom line is, if you jump out at the wrong time just because you can't sleep at night, you are going to end up with less returns, guaranteed.
Okay, that's speaking from the engineer. So the second question is, and it leads from what I just asked previously, was regarding gearing. Now gearing in long-term investment, which we obviously do very well at Emperor, is something new to people.
Yeah.
Maybe help the clients understand the benefits of utilizing gearing in a long-term space with equities, not only from a return point of view, but also from a fund management point of view, agility in the market point of view. Maybe you can just give some more insight.
First of all, is we all use gearing, we simply don't realize it. When you buy a car on hire purchase, you're actually using gearing. You're using the bank's money to buy the car, and you're paying off that amount over a small amount every month over a period of time. The same with your house. House costs $1 million. You don't have $1 million in cash. Go to the bank, put a deposit of 100,000 rand down, and you get funds, a bond for 900,000. That means you've got a 10 times gearing. So whatever profit you make on the house is increased 10 times simply because you only put down a tenth of the actual capital outlay. But at the same time, you make a loss when you sell your house. That loss is also increased 10 times because of the gearing.
Yeah.
All right. So gearing is simply a two-edged sword. When the market goes up, you win by the amount that you have the gearing, and when the market goes down, you lose the same amount. Okay. And that means, in order for us to on the long term to make use of the gearing, we want to lock in as most of the upside moves as possible, where we do use a lot of gearing, and in the bad times we want to use as little gearing as possible. In fact, we would rather want to go under gearing where we have proportionate cash. Now that is the logic behind it, but it's far more difficult to do in practice than it sounds in theory. Okay, and I'll explain that as soon as we get to the current market assessment, where I will show you with areas where we want to be highly geared, where there's good conditions for market investment, and areas where it's bad conditions. So it boils down to probability. If you have a high probability of making money, you can afford to go high gearing, because gearing will increase your returns.
Yes.
If you have a low probability of making money, in fact a high probability of losing money, then you actually don't want to have gearing at all. You want to be out of the market.
Correct. And something that I really try and hit home with people is the benefits of gearing when it comes to, or in a geared environment, when it comes to not only increasing the gearing like you've spoken about, but reducing it when the probabilities are lower. But then the third part is increasing the gearing again when the probabilities are increasing again.
Yeah.
Which in a vanilla equity investment you just don't get.
Exactly.
You earn and you have to wait and ride it out. Whereas with a lot of the Emperor investments, you get that ability to essentially take advantage of very attractive conditions without putting any more money in.
Yeah.
And that is one of the big reasons why it creates a lot of agility and also enhances returns over the long term. Would you agree with that?
Exactly, and we can certainly point out that over the last 4 or 5 years we utilized that very, very well. And as soon as we go to the market assessment, I'll point out some of those special periods where we were able to detect this is the time to add a little bit more gearing in, and we got the returns for that.
Fantastic. And the last question I want to ask, it's quite a broad-based question before we get into the market assessment, is from your point of view, what makes the Emperor strategy, the overall philosophy that we use, the quantitative philosophy, what makes it so special and what makes us perform at the level that we do? And the second part to that question is, a lot of people ask, what happens when Tom is not around anymore? And what's the impact on my investment, etc., etc. So if you could talk to both of those, that would be great.
Well, first of all, is my experience is that investors rely far more professional fund managers, which demonstrate that concept very, very clearly. And it usually has to do with information. If you have a little amount of information, you're less confident than when you have more information. So what typically happens is the more information a fund manager gets, the more confident he becomes in making decisions. However, actual results does not follow the same pattern. Actual results increase as information increases, and as about 20% of the information is available, thereafter it goes constant. So the only thing that then goes up is the confidence of the fund manager, but the results doesn't follow.
It's very interesting.
Okay, and those are solid, rock solid studies done by various researchers that confirms those type of results.
Yeah.
So the real thing here is being honest with yourself as a fund manager and says, where are my deficiencies? And certainly I've realized that judgment is certainly not one thing you can rely on. Okay, so by actually acknowledging the fact that I cannot rely on judgment, you are forced to make another plan, and that's where the numerical side of things come in, because quantitative investment is simply generate a scenario backed up by numbers and go and test it, what happens with it. So as you backtest scenarios and so on, you eventually find out that here's a certain mix, if you like, a recipe that gives you a perfect cake. And then it's certainly a question of writing down the rules and keeping to those rules. So the advantage for the Emperor clients is that whenever I leave, the rules will stay. So it's just a question of following the rules. At the same time, I leave all the tools behind that allows us to develop better strategies over time. And you can do it, you can fast track it, because you can backtest the strategies over a long period of time, and you can do it very, very quickly using computers. So with that set of tools, you can always get a new idea and go and test it and see if it holds any worth value. And then if you do find a better strategy, then it's easy to implement it. So the development time to get to a new strategy is far quicker with quantitative strategy than with judgment. Because with judgment is really belongs to a particular person. You cannot teach another person judgment. So if you happen to be a good fund manager who has good judgment, that's not easily transferable to anybody else. So by having a quantitative strategy, we can transfer that knowledge through the tools and the rules that we've developed over the last 10, 15 years.
Fantastic, and I hope that puts quite a few people at ease. And it's a genuine concern, you know, what happens when the man behind the strategy leaves, and it's something that's going to happen at some point. But the benefit with Emperor is exactly what Tom said. Being in a quantitative investment, the risk is very, very low in comparison to other subjective fund managers that you may very well be invested in already. So thank you so much for that, Tom. So the last part of the interview really is to take a look at the current market, because you know the global financial system, especially from a stock market perspective, has been scary over the last few weeks for investors. Lots of volatility. So without going into too much detail, would you mind providing us with a bit of insight into where you think it is, where we're going, and so clients can sit back and say, okay, I know exactly what to expect potentially from the next few months, as well as some sort of forecast for the next few years.
Okay, let's just break here and allow me to get to the screen, and then we can take it from there.
Excellent, thank you.
All right, first of all, before we talk about what the markets have been doing, let's just describe the overall economic environment. America is in a decent growth situation. Europe is probably recovering from a very, very slow growth environment, but the prospects looks far better for Europe than it used to be. Greece has been bailed out, and it will probably get a couple of other more bailouts, but the Greece problem is now behind us. And certainly the other big countries, Portugal, Italy, and so on, have certainly shed off their problems with debt, and Ireland is chugging on very nicely. UK is okay, there's good property price growth in there and so on. And what we've seen now lately is that the resource producing countries, like in South Africa, Brazil and Russia, has really catapulted downwards in terms of the exchange rates. The ruble is down 60%, the Brazilian real is down 60–70%. In fact, we have been lucky that our exchange rate has only depreciated by 10 or 15%. Although it sounds very bad to us, we could have been in a lot worse position. And although we may be technically in a recession with 1 or 2 quarters of negative growth, it's very shallow growth. Compare that to Brazil, where they've got a very deep recession currently. So we need to be thankful for what we have in South Africa and not only look at the bad things. All right, on top of that, China has been cooling off, and that's the main reason why resource prices and oil prices have come down. And the question is, how does China's turbulence, which they currently are experiencing, impact us in the global financial market scene? All right. So let's come back to the JSE, which is the price graph you see above here, the blue curve over here, and we can see that our market peaked at end of March during April at around about 55,000, just north of 55,000, and then the market started coming down, had some turbulence over here, and then coming down even further. So now the question is this far enough, or is it still going to go down further? If it goes down further, there's a big question being asked by investors: are we heading for a crash? So let's just look at it at a technical basis, and technical analysts will talk about a head and shoulder pattern. And here's the head and shoulder pattern: left shoulder, head, right shoulder. And all I need to say is that from a technical perspective, this pattern is played out. We've hit the bottom as far as the technical pattern has been predicting, so we don't need to be concerned about that one further. If we look at the possibility of are we heading for a crash, then it's a little bit more difficult, and I want to answer it in 2 ways. First of all is, for a crash to happen, there must be a generalized displacement in thinking. In the previous bubble, we had the displacement thinking that house prices will always go up. And as a result of that, a whole new industry developed in the USA that caused a frantic speculation in property, which eventually turned into a bubble, and then when the bubble burst, we had the global financial crisis. So for a crash to happen, you must have a bubble. For a bubble to blow up, it must have displacement thinking, it must have a fuel, and it must have participants that are speculating widely. Now, if we just test the last one, there's no big evidence of speculation worldwide except in China and on the stock market. And that bubble has already burst. The stock market in China has already come down 40%, and it has been from very high valuation levels. However, only 3% of the Chinese stock market is owned by foreign investors. So to a certain sense, it's the stock market events in China needs to be ring-fenced from other investors. So the link that investors are feeling from what's happening in China is simply through the growth prospects of China, where they say, well, the growth in China is just going down the drain. And that quite simply is untrue. China is still growing at one hell of a pace, 6%, 7%. The problem is that they are not totally transparent with their numbers. So we're always unsure whether we can believe their growth numbers or not. And that's where the problem comes. The uncertainty comes in current market thinking is, are they going to continue their growth, or is there actually zero growth? The answer is that there's no question China is still growing at one heck of a pace. Maybe at a lower pace than a couple of years earlier. So from that perspective, there's no displacement thinking in the world, and therefore no bubble. So I can honestly say that there's no chance of an additional market crash happening from current levels. But let's prove that point. If we can go on to our next slide, please, Greg. Our market confidence matrix, if you like, is based on two factors. A rational factor, which we call market valuation, and then we use the rule of 18, which is an inflation-adjusted parameter of the current PE ratio. We call that the rule of 18. And as you can see here, that the average for a market, according to this rule, is 18, then the market is averagely priced. Anything above that, the market is expensive, and anything below that, the market is considered cheap. And we saw in 2008, the market valuation came down extremely low to a value of 10.5, which was dirt cheap. In the previous bull market, the valuation hovered between 18 and 20, and that was as a result of high growth in South Africa as well, where our growth rates were 3, 4, 5% per annum. Right now, we see that in the latest bull market, our market valuations have hovered a little bit higher, between 20 and 22, simply because the growth rates of South Africa were a little bit lower, 1 to 2 to 3%. But it's still within the parameters of a bull market, because in order to get an average valuation of 18, and in a bear market to have a lower than 18 average, that means in a bull market you need to have a higher than 18 in order to make the average 18. So that's simple logic. Okay. So we need an above average of 18, sort of an expensive market, that in order to have a sustainable bull market. So there's nothing wrong with the current market valuations. It has come down from 22 and is now at about 20, so that's roughly 10% less. So for a bull market, it is quite fairly valued at this point in time. All right, let's go to the irrational factor. Now, irrational factors are based on emotions of investors, and the two emotions that we see primarily in the markets is greed and fear. Now, greed is something that is good for capitalism and good for investors, because if there was no greed, nobody would risk anything. Okay, so we need a certain amount of greed, but when there's too much, an excess amount of greed, you get speculative behavior and you get bubbles formed. So anything above 60% in our market sentiment scale is good, and that's where we say that's where greed is generally the dominant emotion, and we have a positive market sentiment. And what this simply means is that 60 out of the top 100 shares, where most of our activity in the market is, are actually going up in price. And when shares are going up in price, investors feel good because they're making profits, and they want to add more to that because that's the greed factor. So the general result is, when we are above 60%, investors will tend to add to their investments, and therefore it will push up the market even higher. Below 40% we have an overriding fear of emotion, and that means that the investor will be inclined to sell. And as you know, when you sell, you push the market down, and as the market goes down, even more investors are inclined to sell. So there again, that's a spiral to the downside. And that's irrational, and that's what causes market to overact, on the upside as well on the downside. And the irrational factors you need to combine with the rational factors that will form the complex system, which is how market behave. So right now we are at 54% market sentiment, which is neutral. That means we can go back up or we can actually go down. So we already talked about the possibility of going further down, and that can only happen when there's a displacement and when there's a bubble. And then when the bubble bursts, that's when you get the additional move down. So the normal expectation in the absence of a bubble is that the market must recover from this point and go up. So let's go to the next slide, which is the final slide. So here we add the valuation parameter and the market sentiment, and we combine it into a final, what I call risk matrix. And some investors of you may have seen the previous risk matrix, where we reported an 84% probability that we will generate a return, a positive return over the next 3 months. Now since then I have updated my risk matrix using new information that had become available in the last few years. And we've made some other minor changes and so on, so we had to recalibrate this whole risk matrix. And now 60% market confidence is considered as the average. As you can see, the average for all conditions is 60%, and therefore at 60% confidence we will tend to have normal gearing levels. So whereas maybe a month or two ago we said that we should be slightly above normal geared, for the conditions we are now at normal risk gearing levels. So if your ideal gearing level is 160%, that's where we want to be, right now at 160. Because our current market valuation of 20 compared with our market sentiment of 50, 55 means our confidence is between 60 and 63%, which is slightly above the long-term average of 60%. So if we have to look at it in a holistic point of view, then being slightly higher than your ideal gearing is fine, but at your normal ideal gearing is also fine. The point here is that the risk for a market crash is only experienced when the confidence levels go below 50%. And this is this red block over here, this rectangle over here. And we are still a significant amount away from that. Okay. But should we go down, then we will very, very quickly get to a point where we go below 50% confidence level. Our current opinion is that there is a very, very low probability for a market crash. We're not seeing any evidence of that, and therefore our expectation is that at this point in time, the market should go up further, although it may be a very difficult move, a lot of turbulence, up and downs. But I'm of the opinion that the August low we've seen has already been the ultimate low, and then we should go better from here.
Good, thank you, Tom. Thank you very much for all your time. Really appreciate it. Guys, I hope you enjoy that, and look out for the next interview that we do.
Thank you, Greg, and all of the best.
Thank you.